Now, as we turn to Europe, we just want to talk briefly about some of the Eurozone service and composite PMI. So when we look at what happened in the Eurozone aggregate, so the expectation for the services PMI in February was supposed to be 44.7, came at 45.7. Eurozone composite PMI was supposed to be at 48.1, came in at 48.8. Slight positives, but it's still not an expansionary territory. It's still in that contractionary level. And with the fairly stable moves in COVID or slight increases in COVID, you were seeing some of these issues coming up time and time again. Now, when we look at some of the backdrops of the European Union in general, when we start looking at, the different PMI aspects, and then we start looking at, okay, let's look at Spain. So Spain coming in at 43.1, composite 45.1, Italy surprising a bit to the upside on 48.8, and the Italy composite at 51.4. So Italy had the nice surprise. Now 51 is still not exciting, but again, still in slightly expansionary. But then on the French side, France had a better number, but still in a contractionary level. Same with Germany, so France service PMI came in at 45.6, composite at 47, about 2 points above estimates, but still in contractionary. And then Germany, the services was supposed to be 45.9, came in at 45.7. And then the German composite came in at 51.1 versus an estimate of 51.3. So Italy's starting to see a little bit of a bounce, but Germany's starting to see a little bit of a slowdown. And this is where we keep seeing this kind of friction back and forth as to where are we going to see some of this turning point for the European data. And that's where when we look at this and say, okay, well, let's go back a minute and say, what is happening on the employment side? And when we look at, as we talked about with the manufacturing, some of the manufacturing is getting better, but the composite mixed with the service side becomes a bigger issue in general when we see how much activity are we going to get back out of Europe in general. And then one of the other bigger issues is some of the slowdowns in retail sales that have started to come into the market, with unemployment rates actually going up in Spain, and you're starting to see some of this unemployment surprise to the upside, which is a net concern. And now when we look at the bond yields and how are they marrying with the U.S., so the U.S. yield curve has started to go up, and now the European zone yield curves are starting to move up in tandem. Now, given they're moving at a slower rate, but they're starting to see that catch up, especially as some of the inflation numbers have gotten much higher, and there was a big swing and a miss with retail sales, which is putting some headwinds. But we'll put that the retail sales into context when we get to it. Now, when we look at just what is happening on the Euro swap, the GDP weighted 10-year Euro area, this is where we're seeing these movements back up. So we've had this pretty steady down move from even before from essentially the beginning of 2020 through the end of 2020. But now that we're getting into this, we're starting to see this perk back up and come back to where we were really back in 2019. And this is where we're starting to see some of these concerns of, well, what is Lagarde going to do? Is she going to come out and make some sort of statements to try to keep some of this tampered down? And how much opportunity does she really have to be supportive? So then when we look at GDP estimates for Germany being the strongest country, the problem, the benefit is going to be exports. So when we look at exports, we have to think about, well, what is the cost of those exports? And this is where we look at the euro, and the euro is going to have to price itself to a point where it'll help incentivize moving some of these euros into the market, because right now private consumption continues to be slow. As you can see, it's barely even registering in the forecast. And the GDP is really going to be a benefit of public consumption, construction, and net exports. And that net exports is the one that we think is the most sensitive and could be the one to miss the most to the downside, just given some of the backdrops in the market. And the reason why is when we look at the global supply chain disruptions. So when we look at those disruptions in the euro area, think back to when we talked about Taiwan, the shortage of semiconductors, how they're trying to make semiconductors for for autos to try to close some of that gap, and that supplier delivery time is remaining in the market. New orders have gotten stronger, which is supportive of some of that PMI data going forward, which will help pull that into more of a expansionary territory. But the supplier's delivery time, and then that is the overarching issue, and then the employment is starting to maintain a little bit of a stability, but this is for February. But as we go into March, we're seeing some of those unemployment numbers tick up a little bit and get a little surprising in terms of where they actually are, specifically in Spain. Now, when we look at the profit distribution, so typically the Bundesbank will take the money that it's made and give it to the German government. And this is going to be the first time in a long time, as you can see at the bottom here, that there won't be any transfer. So it'll be the first time since 1979 the Bundesbank won't make a transfer to the government, speaking to some of the issues or fears that remain at the banking and aggregate level on bad debt and just what sort of support that will be there. Now they have cash, so it's not like they're sitting there not giving because they don't have it. It's that they're keeping it on their balance sheet to be proactive in trying to provide additional support in general. So then when we look at the French side, so again, this is looking at that new orders. So new orders inventory continues to drift up, which is what we were talking about with the PMI. So industrial production is going to see that the 3-month average continue to drive higher. Manufacturing production will follow. Now, it's not going to get back into expansionary yet, but again, it's still getting to a more normal level. The problem will remain service on the service sector as well as the tourism side, which will kind of cap how much of that benefit will come through. So when we look at just what we're seeing in some of the French numbers in particular, the one that we want to point to is the CPI level, where we're starting to see those increases in CPI. And the manufacturing is starting to surprise to the upside, which we showed, but we're seeing PPI going up. And that happened in January, continued in Feb, and now we're starting to see some of these increases in terms of just where the growth of inflation is starting to come out, and that's going to weigh on just what is actually happening in general. Then when we look at the ECB balance sheet, well, let's take it and say the ECB balance sheet has hit another fresh all-time highs as Lagarde keeps the printing press rumbling. Total assets rose by 9.3 billion euro to 7.1 trillion euro. In the past week on QE, the ECB balance sheet now equals 71.3% of Eurozone GDP versus the Fed's 35.3%, the Bank of England's 37.7%, or the Bank of Japan's 129%. So again, the Japanification continues, but how much can Lagarde continue to do given the amount of stress or the amount that's already being purchased? So then when we look at, well, there was actually a reduction in some of the activities that were done on the PEPP net purchases. So there can be a reversal where they can come out and say, look, we're going to increase net purchases. This will help protect, tamper down yield. But with inflation starting to tick up, how much can there be a continuation in some of these movements? And this is where we want to look at what is happening in general, because when we go back through 2021 so far, this is at the lower end of what those net purchases really look like. And so there can be an increase, but how much support can really come into the market. So now let's look at the ECB on a weekly pace. And here you can see that big slowdown in terms of the average being about 12 billion euro. Now it's down obviously from March and June, but since July they've been averaging about 12 billion euro, and you can just see how big that drop was. As we're seeing rates start to increase, there'll most likely be an increase in activity to try to tamp that down, but we're already seeing that pressure coming through, and it's filtering through the PPI side because when we look at import prices for the US, they're no different. Like, let's look at commodities, let's look at energy, let's look at things in general that are being consumed. All of that continues to go up, which is just going to have to get pushed on to the consumer in general, which is a problem as retail sales start to weaken and we continue to see unemployment as a bigger problem. So then when we look at consumers expected the savings rate to remain high. So the consumer continues to save, but they're losing money by saving because the banks have tried as long as possible to not charge people to save money. But now that they've exhausted their means of higher fees, telling their institutional investors they're going to have to pay more, it's now hit the consumer side. So you're also seeing more money trying to get pushed into other parts of the market because you're not being paid to save. The cost is increasing, and the consumers expect the unemployment rate to remain high. So if you expect the unemployment rate to remain elevated, which means your chances of getting a job are diminished, and if you do get a job, it'll most likely be at a depressed wage, then you're going to want to save more, but you're getting charged to save. So again, this is where negative rates become a bigger and bigger problem on the aggregate because it's going to impact the consumer and the residential individual way more than it would the institutions, which is why there is that bigger problem on the go-forward level. So let's just take Germany for an example. So let's take bank deposits of German households. So you can see that they've continued to drift higher over the time period, but that means that there's only so much that can be done to protect before they have to charge households. So the ECB's deposit rate, which it charges banks, is negative 0.5%. So the ECB charges the bank to not spend money. The central bank has signaled it is unlikely to change that level anytime soon. Government bond yields against which borrowing costs are measured are negative despite a recent uptick. German 10-year bond yields negative 0.3%. And then similar U.S. bond yields are at 1.5%. Banks in Germany are particularly hit by negative rates because Germans are big savers. Here you can see the increase. About 30% of all household deposits in the Eurozone are in Germany, according to the ECB. Last year, deposits in the country rose 6% to a record 2.6 trillion euro as people became wary of spending under the pandemic and restaurants and things were closed. So this is where people are saving more because there's nowhere to spend it, and you're charging them to save it. So this is where there's the overarching problem, especially with a huge chunk being stored in Germany. Now, as Germany reopens, you'll start to see some of this move into the market and the German economy will start to churn back over. But with some stagnant declines in COVID and delays on the vaccine, how quickly will this move out? And what will be the impacts in general? So then when we take this and we look at core inflation, so core rate had a huge spike as we came into 2021. This was a reversal on the VAT tax, but now that the VAT tax has been priced in, this is also February. So we still have a continued move higher in the inflation rate, even once we factor in the VAT tax and start to see some of that normalization, which is going to be a bigger problem because inflation tempered inflation has been the reason why these central banks and governments could be so aggressive. But now as inflation starts to pick up, they're going to have to temper the amount of activity that they can actually go through. And this is X energy and food, because if we factor in food is up 4%. If we factor in energy now, given the low base effect, energy costs are going up, which is only going to drive that inflation number even higher. And that's when we look at the Eurozone in general. So the rise in Eurozone energy inflation is just getting started, because when you take the energy side, so the trend energy CPI, so we can take the curve and look out to April 2021, and you can see which direction this is going to go. Now take that trend and look at transport services. All of this is pointing to a big increase in inflation. Now the hope is that it slumps back down, but if OPEC doesn't come out and increase production, or at least start to buffer the market as we get into April and May, and we do get a big resurgence of activity in Europe, you can get an idea of just where that inflation is going to go over the next 6 months. And this is looking at the aggregate of easy manufacturing, which is finally starting to turn a little bit positive. Now, what we're seeing in terms of retail sales, increased prices, it'll stay positive. It's just going to be fairly flattish, and it's going to be in a good position year over year. But again, it's not going to see this huge surge, but instead kind of maintain this pretty steady but lackadaisical move over that 0%. And then when we take this and look at annual inflation, this is what we're looking at. What is the inflation in general? So you can see the EU about 1.2%, Euro area about 0.9%. And this is why we're starting to see this skew with Germany at the higher end. And now we're starting to see France, some of these others starting to see that increase in inflation. And we think Italy will be the next one, which will keep driving that number higher. And now, it's still not at a concerning level. It's not like the euro, the ECB doesn't want this. It's just when it starts to get unleashed, what will be the means of slowing it down, given the fact that they have negative rates, they have a very easy monetary policy, and how do you start to temper some of these moves in general, which is going to be, I think, one of the bigger issues as we go into the remainder of not even just the quarter, but into Q2, because a lot of these reopenings are supposed to start in April. And given where things are, how quickly will they start? And then what will be the movements, and how will we see that be reflected in the economy as inflation starts to tick up and unemployment remains elevated in general?